Hello, everybody, and thank you for being with us tonight. My name is Lynn Murrow. I'm the Executive Vice President of Lifestyles Unlimited. Very happy to introduce you tonight to Lu Ann and Dan from Exchange Resource Group, who are going to be presenting how the Biden tax plan will affect real estate investors. This is especially important because we have even more information now than we did just before the elections on what the Biden tax plan has in store. And we also have a Senate race runoff in Georgia. And so why does that matter if you don't live in Georgia? This matters to everyone in the United States because it will determine who controls the Senate, and it will determine whether we have a one-party government where we've got the House, the Senate, and the presidency all in the hand of one party, or whether we do what Americans typically do, which is split the power to give a little more friction, frankly, and a little more accountability for the things that get passed. But the most important thing to know is what the administration for the Biden-Harris ticket has planned for us for the next 4 years, and what they will be seeking to enact through the House and Senate. It informs us how we need to support, if we're not living in Georgia, we need to support those candidates that we think, depending on what your political persuasion is, you need to support those candidates as best you can. And those that live in Georgia, please vote. I think it's really important for everyone to vote. And this was an amazing election year, and really glad to see the turnout. And then the other thing is we're going to be talking at Lifestyles Unlimited about being more active in our communities, everything from city councils on up, and to let your legislators at every level hear what you have to say. For those of you that are invited guests and are not members of Lifestyles Unlimited, I want to extend a warm welcome to you. This isn't going to be a political presentation. This is going to be just the facts. It's going to be just the raw numbers and how things will work out, comparing the current tax plans and laws and the plan that Biden and his team have announced. And if you'd like to know more about Lifestyles Unlimited, please visit us at lifestylesunlimited.com. So with no further ado, I am going to turn this over to you, Lu Ann, and let you get us started tonight.
All right. Hi, everybody. Thank you for joining us. John, you can go to the next slide. I'm Lu Ann Blough, and I am the Regional Development Director for Exchange Resource Group, and I am in Texas. We are vendor for Lifestyles Unlimited for about 7 years, and we are very grateful and value that relationship. One of the things I'm going to start and go over just the 1031 exchange, kind of give you a review of what we do. We're a qualified intermediary. We facilitate your 1031 exchanges, which is one of the things potentially on the chopping block for the Biden-Harris administration. We have a lot of benefits to the 1031 exchange. I'm going to kind of go over what it is and how does it work, and why you as a real estate investor should be concerned about what is going on. Next slide, please. Okay, I think this is our agenda. Sorry, we changed this at the last. So I'm going to go over the exchange, then Dan's going to take it and go over the Biden plan, the highlights of the plan. He's going to compare and contrast it with the current tax law, the potential impact on the real estate industry if they are successful in getting everything they want passed through. And then at the end, we're going to give you some information for a call to action so that you're aware and prepared. And to our Georgia people, who I hope there are a lot of you on here, just what Lynn said, deadline for registration to vote if you did not vote in the November election is December 7th. So please register to vote in that Senate runoff in January. Next slide, please. Okay, so what is a 1031 exchange? A 1031 exchange has been a cornerstone of the IRS code for taxpayers since 1921. So that means 100 years. It was set in motion way back when to help farmers and ranchers increase their buying potential, thereby increasing their revenue, assisting others, and improving the economy. So it turns taxable sales into non-taxable exchanges. Tax liabilities and depreciation recapture can be deferred completely and permanently. It encourages real estate and economic activity, and it provides exchangers with increased cash flow and greater wealth building philosophy. It allows you to defer the tax that you would have paid on the sale of an investment property, and instead of having to pay that money to the IRS, you take that percentage, whatever it is, and you reinvest it into new real estate, thereby increasing your portfolio, increasing your income, and contributing to the economy. Next page, please. Okay, so the section the IRS defines as Section 1031 is where a taxpayer transfers property that they have held for productive use, trade, business, or for investment to new property that they are going to hold for business, trade, or investment. Okay, Dan, you want to go ahead and take it?
Sure. The taxpayer must reinvest their net equity and their debt into like-kind property. And so upon selling any asset that's held for trade, business, or investment, as long as it's a real estate asset, all of the states except Pennsylvania, excuse me, can't even pronounce that tonight, allows you to roll that basis forward into the next property. And so you not only, we usually talk about 1031 as capital gains, but there are several taxes that you are able to defer into the next matter. The first one, and a very important one, obviously, is depreciation recapture. Right now, that's at 25% under the existing statutory scheme. In addition to that, capital gains, which range from 15 to 20%, state income tax, which range from 0 to 13%. And in our state, for the last 25 years, I've said 4.63. We actually rolled it back, so it's going to be 4.55 come January.
And you are in what state, Dan?
Colorado.
Okay, Colorado. Got it.
Then a number of states have state transfer taxes, Florida being one that comes to mind. And then everyone, if you make enough money, you're exposed to the net investment tax or the Medicare surcharge, which is another 3.8%. And all of these build on one another. So the tax can end up being somewhere between a low of 15 to 20% and a high of 30 to 35%, particularly in a couple of really high income tax states like California, where it's 13.3 max, New Jersey, New York, Illinois. Those high income tax states have high state capital gains taxes also. So it's something to be very well aware of. Next slide, John, please. So, you know, if you add these all together, they add up to a very, very significant number that basically acts as a huge anchor on your ability to move forward. Because with each and every one of these transactions, if you have to pay this tax, it reduces your ability to move forward. We're going to show you exactly how that works here with the next couple of slides. So if you want to move to the next one, John, please. So we're just going to take an average residential property that you purchased 10 years ago for $270,000. You're preparing to sell it. 350,000 is the gross. You're going to net 3 1/4 out of that by the time you deduct the cost of sale. Over the last 10 years, you've improved the property to the tune of approximately $20,000. So let's look at what that means. During that 10-year period, you managed to take $98,000 in depreciation, which gives you a property tax basis of $192,000, which is your purchase plus your improvements minus your depreciation. Therefore, your overall gain is $133,000. Okay, so theoretically, you've made $133,000 on that transaction. Let's see how the taxes will apply to that. If you don't do a 1031 exchange, you're going to be confronted with depreciation recapture on $24,500 at 25%. Okay, that's the 24,000 is the tax. You're going to have remaining gain of 35,000, which is the difference between the taxable gain minus the depreciation recapture. Then you're going to see a capital gains tax of $5,300, which is 15% of that 35, and then you're going to see the surcharge of 1,300. So by the time you add all those together, you can see it's a pretty sizable tax hit because you're going to pay the 24.5 plus the 5.3 plus the 1.3, and that's assuming that you live in a state like Texas or Wyoming that doesn't have a state income tax. If you have a state income tax, then you're going to have state tax on top of this approximately $30,800 that you're going to be paying in taxes. Okay, here's a side-by-side comparison. The recapture, 0 on the 1031, 24,500. The cap gains, 0 on the 1031, 5,300. Medicare, the Affordable Health Care Act is 0 versus 1.3. So at the end of the day, and if there is a state, whatever it might be, and the states generally range from about 5 to about 13. So even without a state income tax, you're going to be looking at a $31,100 tax hit versus a 0 tax hit. And quite frankly, for that $31,100, you're not even going to get a nice thank you letter from the Internal Revenue Service. Whereas if you can keep that $31,100 in the ball game, think of what that can do for you down the line. John, let's show them what that'll do over a period of an investment. Here's a couple of the proposals that these are directly from the written tax plan that the Biden campaign started publishing about 16 months ago. So this isn't any words out of a politician's mouth. This was the written documentation of the Biden campaign. Currently, corporations are paying 21%, which is a reduction. And what that served to do, quite frankly, as just an aside, is bring a lot of manufacturing back to the United States, because that put United States income tax, federal income tax, on the same scale as a significant amount of the rest of the world. The proposed increase rate is 28%. On individuals, the maximum today is 37. The proposed increase is 39.6. Now here, let me just stop you and say the difference is, and I want to point this out and we'll deal with it as we go through, is what that 39.6 or what that 37% is applied to. And yes, it's only a 2.6 increase, but when you realize that they're going to put a whole bunch more items in that bucket that gets the 39.6 applied to it, you'll see that it's going to make a very, very significant difference. The Biden tax plan proposes to eliminate Section 1031. So it's going to mean that all the realized income becomes taxable at ordinary tax rates, so that what you saw in the last example, that roughly $35,000 in taxes that was going to be due under that plan, will now be taxed at another rate scale. He's moving all the rates up. So rather than it being taxed at a maximum 20%, it'll now be taxed at a maximum of 39.6.
Hey, Dan, can I break in?
You bet.
So just so you all know, we're not making this up. We have gotten these numbers basically from is it the Tax Foundation, Dan? Is that where we've gotten most of our information?
Correct. Absolutely, yeah.
And that is a basically bipartisan website that just looks at what's been put out there and deciphers it and lets us know.
Yeah, let me just point out something here as an aside. This is not the first time that the D's have proposed doing away with capital gains taxes. I think I first testified before a congressional committee during the Clinton administration a number of years ago, because it's come up numerous times before. It's been dealt with. It's been cut away at. Just so that you all know, in order to get the tax plan passed the last time around, because of the congressional makeup, President Trump's plan had to give up 1031s on non-real estate assets. We used to do a lot of personal property assets that were held for trade, business, or investment. So things like aircraft, fishing boats. I've done 8 or 9 railroads where you've got a lot of rolling stock. Those used to be 1031able also. But the D's, in order to get the votes to pass the overall tax reduction back to the 21%, they had to give up something, and that was the D's requirement. So they've been chipping away at it for as long as I can remember, and I've been doing exchanges since '77 as a part of my practice a lot. So this is nothing brand new. We face it, we battle with it, and but in this particular environment where I believe that the D's have promised so much to so many, they're going to have to generate a huge amount of tax increase income. And so I think they're going to be even more serious about getting rid of it this time around than they have ever been before. And so, you know, I believe it was Thomas Jefferson who said, "No man's person or property is safe while the legislature is in session." And that certainly is true. I think we can all admit that. And again, I don't mean to be political about this. I'm trying to be, you know, purely business related to it. These are facts I can back up. These are facts that we get from several sources. Number one, obviously, is the Tax Institute, which is a pretty libertarian, pretty middle of the road, been using it for years as a tax effect projector and a tax effect reporter. That's one group. Number two, you'll see mentioned a little bit later on, is the Federation of Exchange Accommodators, which I've been involved in and president of for years. And that's the group of qualified intermediaries around the United States. This is what we do. This is what we've done for a number of years, and this is how we help people. So I'm trying not to be political. I'm just trying to give you what the proposals are that are before us. Let me move on here to the tax rates for middle earners, those who earn between 800,000.
Oh, wait, John, go back one.
Those will jump up also. Let me just, fair enough to say, those middle earners, 800,000, 900, 469,000, those will increase also. Now, I heard Mr. Biden say in at least one of the debates that he wasn't going to raise income taxes on anybody over 400,000 who makes less than $400,000. And I can't, number one, that's not in his plan. Nowhere is that figure in his plan. Nowhere is that. And B, simply by doing away with the existing tax plan, he's going to raise everybody's taxes. because all of the rates are going to go up. So no matter what your income is, that category that you're in, whatever your rate is going to increase. And so you can see it's going to increase from 15% to 24%. So that's not quite true. Simply by doing away with the existing tax plan, all of our income taxes will go up, and then as will other taxes. Okay, let's go on, John. The other thing that is hugely important is that he proposes to do away with what is called a step-up in basis. Let me tell you about step-up in basis. Step-up in basis is where you inherit something from grandpa, and you get a basis in it as of the day you inherit it, not the day grandpa bought it. So currently, you get that step up. So let's just assume, for the sake of argument, that grandpa bought something a number of years ago for $50,000. He depreciated it out down to 20. Today it's worth $300,000. You get it at its current taxable value, $300,000. So 5 years from now, if you sell it for $4, your gain is that $100,000. If Biden does away with that step up in basis, which he proposes to do, you would have a basis. You would get grandpa's basis of $20,000. And so when you inherit it, this is where it's a little unclear, because there is no definitive plan whether you're going to have to pay that capital gains tax at that point in time, or if you're going to have to pay those taxes when you sell the property, triggering a $20,000 basis versus a $400,000 sale. Now, at least one member of the Democratic Party, Ocasio-Cortez, has proposed that these taxes ought to be imposed every year, so that every year you ought to have to estimate how much your property went up and pay a tax on it, whether you're selling it or not. So, there's a significant amount of movement proposed in the tax plan that's going to have an effect on all of us. And I know for an awful lot of people, the step up in basis has been a long-term tax planning strategy to buy a property, hoping to leave it to your children, and hoping they're allowed to benefit from it. And this is going to have a substantial effect on all that planning. Now, whether they're going to do something about the inheritance tax, who knows? I was talking with the CPA today, and he said, if they do this, I think that they will also drop down the exclusion on the inheritance tax to a $2 or $3 million figure. So all of this remains to be seen. And again, like Lynn said when we began, if there's some checks and balances in the government, that's one thing. If it's a straight D card all the way up and down, we're going to see a lot of other things happen. And I'm speaking from experience, having been in front of the Colorado legislature, which is now completely controlled by Democrats, and testifying on bills there. Substantially different way of looking at it. There's no checks and balances. They just do what they want to do. Okay, John. Potentially this eliminating the step up in basis is going to create additional potential taxes on debt, or a substantial increase in taxes upon sale. But one way or the other, the elimination of step up in basis is going to substantially increase the tax burden on owning real estate. And here's a quote from Investopedia. This change could prove very costly over time to heirs of appreciated property at all income levels, not just the wealthiest. And quite frankly, my limited experience, I've only been around for 73 years, but practicing law for 49 of those, but is that that on the lower wealth levels, the transfer of real estate has been one of the basic ways that wealth has transpired. For people who did not have, and I'm looking particularly at farmers and ranchers and small homeowners. It's been one of the ways that wealth is appreciated to other generations over the years. Okay, John. And then again, if they eliminate 1031s, you're going to lose the ability to defer. You'll become subject to the ordinary income tax versus capital gains tax.
Dan, why is that? For my, what? Can you go into a little bit how they're going to change that from long-term capital gains to ordinary income?
Well,
I think that's confusing for people.
Well, no, what they're simply doing right now, if you sell a property and you choose to pay the tax, your capital gains tax are taxed at a specific capital gains rate that runs from 15 to 20% depending on your income, right?
Right.
Okay. And if the Biden plan is adopted, there will be no more capital gains rates. So all income will be taxed at your ordinary income rate, which is somewhere between 24 and the 39%. Okay, so everything gets taxed at that greater rate. There is no, right now depreciation recapture is set at 25%. Okay, depreciation recapture will go into that pot and be taxed at 24 to 39%.
Right.
I don't anticipate the Medicare or the Affordable Health Care Act surcharge changing. So you'll still be hit with that. But what we're pointing out here is your 15 to 20% rate is going to change. Your 25% rate is going to change. And you're still going to have the state income tax, and you're still going to have the 3.8 Medicare surcharge. So the reality is your tax burden is going to increase realistically somewhere between 10 and 15%.
Got it. Thank you.
No problem. That's what we're here for. If somebody else has questions, type them into Lynn. We'll try to get to some answers for you before we're done tonight. Next slide, please, John. What I'm going to do fairly quickly is just walk you through an example of someone who used the 1031 and someone who did not use the 1031 over a 20-year period of investment, and understand that we used low numbers on this. As you're seeing, we're only using a 20% tax rate. We didn't add the state and everything else to it. So just to try to make some things understandable. So in the first transaction, on the first sale, a sale of $100,000, the client gets to keep $100,000 and therefore can buy a new property of up to $500,000. You can see what happens if they don't do a 1031, and you can see our best guesstimation of what the results would be with the Biden plan. John, if you want to move on to the next one. So here we are after 10 years, and you can see what it does.
5 years. 5 years.
5 years, I apologize. Before the first one for 5. So it gives you a net investable amount of $690,000 versus $442,000. So you can see that your purchasing power and thusly your ability to step up is gaining rapidly as things go along. And if under the Biden plan, you'd be down to about $360,000 rough number. Next slide, please, John. And it keeps multiplying, and it starts to move really, really rapidly. Now you're at almost $1 million of new property capability versus less than half that with no 1031s, and about a third of that under the Biden plan.
And we're making an assumption on this that the value of the property that you're bought is going to go up in value 5% annually. That's where those numbers on the left side come into play, where we get those numbers.
We're trying to be, you know, we can't always hit right on, but we're trying to get as close as we can.
And we don't factor in depreciation recapture on this either, because we can't.
Yeah, it just gets too complicated. Next slide, please, John. Here we are at 20 years, and look at the difference. You know, the new property capability, 3.6 million versus 802 versus 358. Taxes paid 106,600. All right, 110,800. But the big number for anybody who's looking at growing their wealth and growing their retirement and growing their capabilities, as Lifestyle does so well, is that new property investment figure. What you can take down with that new property, and it's just it's such a huge number over a relatively short investing lifetime of 20 years that it's kind of staggering when you get to the end of it and look at it and realize that, you know, you can take down 4 times as much by simply using the 1031.
And then leave it to your kids and that tax goes away forever.
Potentially. Yep. Or move into it, or there's a whole bunch of strategies that you can do that we'll be glad to help you with, and Lynn and John are very, very experienced with, and they've helped a lot of people do it. And so if you're not involved at this point in time in one of their programs, I as just an independent guy who sits here helping people every day save money on their taxes, really suggest that you look at it. The School of Hard Knocks has a really high tuition, and you'll learn a lot from those folks. Okay, John, I think I patted you on the back enough. The numbers we're going to show you now are from the Tax Institute, and they attempt to, the Tax Foundation, excuse me, they attempt to extrapolate what the real world effect of tax modifications will be. And the most recent thing we have from them, and again, they're not on either side of the fence. They attempt to straddle the fence and just give people like myself who are tax geeks a look forward and a look backward, quite frankly. But in this particular case, a look forward into what we can anticipate with these tax changes. And you have to realize that there are always unintended consequences and always factors that, at least from my experience testifying before them, those people inside the Beltway have no concept of. They just, I mean, I've been involved in conference committees with the Internal Revenue Service. They don't realize that people outside the Beltway own 3, 4, 5 pieces of real estate because all they can afford to do is pay their Georgetown townhome payment. And they don't realize that this is a methodology, because they're involved in the federal government and that's their retirement, that people on the outside are out there looking for ways to build their own other than simply relying on their employer. So back to the Tax Foundation General Equilibrium Model. They ran this in November of 2019 when Biden's plan first came out. Applying it to the economics, they estimate that the gross domestic product will be reduced by 1.51%. That the capital stock, which is the gross wealth of the United States, that's not stock in the stock market, that's the gross capital value of assets in the United States, will go down by 3.23%. That the wage rate will go down by 0.98%, and that there'll be a full-time equivalent job loss of 858 585,000 jobs. And that's across a number of lines, from construction to banking to lending to real estate sales. And that's purely based on eliminating the 1031 tax deferral and eliminating the step-up in basis. So if you look at that, that's a pretty significant number. I mean, if any of you want to give up 3.23% of your total wealth, I'm sure Lu Ann would be glad to accept that from you. But I don't think anybody does. And I don't think anybody wants to take an almost 1% cut in pay. I know I don't. But these are just, I mean, these are numbers that you're not going to see any place unless you dig down pretty deep into the publications of Tax Foundation and other organizations like that.
And the ramifications are not just real estate investors. You think your property managers, your yard workers, all the people, all the other people that contribute to our real estate industry now as we know it, they'll be devastated.
Well, and one of the factors, one of the large factors that brought the economy up when, you know, pre-COVID was the construction industry, because investors can handle almost anything but uncertainty, and they saw a history of solid tax, you know, business-orientated tax planning, and they were willing to invest. And so, you know, this is the best guesstimate I can find of what the future holds. Ernst & Young did a study on behalf of the Federation of Exchange Accommodators and said that without 1031, many real estate transactions would be either delayed or abandoned. Values would erode. And they anticipate, this is 2015, 2016, okay? So extrapolate those numbers a little bit, that the economy would be contracted by more than $15 billion annually. And their calculations showed that the tax revenue would decline over time rather than increase if Section 1031 was eliminated. So rather than people continuing to grow their portfolios and ultimately at the end of the day paying more money, they would constrict and ultimately at the end of the day end up paying less tax dollars. Okay. We hope to have some, we haven't seen the new FEA studies, but we did poll the realtors 2 years ago, and 40% of those realtors stated that without a 1031, some of their transactions would not have been acquired, and transactions would not have occurred. What's interesting is that at the end of the day, 88% of the properties acquired in an exchange are disposed of through a taxable sale. So most of the deferred tax end up getting paid. It just doesn't get paid today. It gets paid tomorrow at a higher rate because of the tax. Obviously, with this short exception of the state of Colorado here this time around, everything else is going up. Next, John. So ultimately, you can see that what we need is a call to action. If you reside in Georgia, obviously, there's something you can do about it here very, very soon. But if you'd like to go to the Lifestyles portal, there's a legislative action, and I'll let Lynn speak to that a little bit more. But I would really encourage you to let your legislatures know what you think. The reality is, as odd as this might seem, you can walk up to almost anybody who's in Congress and say Section 1031, and they look at you like you're speaking French. Because it isn't something they deal with on a regular basis.
On the other hand, they've all made some of them have made a lot of money in real estate, but they may not realize it's been through the 1031.
Well, absolutely. But but also they make a lot of money from real estate for their reelection campaigns. But Lynn, I'll let you speak to the Lifestyles portal and how you'd like to deal with that.
Sure. This is for Lifestyles Unlimited members. And one of the things that we provide in our education and mentoring program through our membership portal is a legislative action link where we give summaries that are from a variety of different sources of what the legislative actions are that are in play at the moment. We make it easy to link to and find who your legislators are if you're not sure. And we'll give some sample letters to get you started. We like for people to write their own letter. So because form letters don't have the same impact, when they start getting thousands of emails with the same heading, the same format, the same words, right? It just kind of gets ticked off of, okay, we got one more from this group. But we like our members to maybe use a template a little bit to get the points out, but to tell their own story. And that's what we're asking you to do here. And we're really just asking you to participate in the American process, participate in our democratic republic and vote and let your voice be heard. And for those in Georgia, this is a critical vote for your state, but also for the nation at large. And I'm sure that's not lost on anybody who might be on this call that's from Georgia, that all eyes are on you, right? And it is not uncommon for, as I said before, for Americans to split the power in the United States. It's been relatively rare that a single party holds power. And often when they do, it'll be 2 years. And then people remember why we don't do this. And then you'll see a big change the following year. It's clear that Americans are split on some issues. And it's important that we have that balance reflected in our legislative bodies. So, and this is important for anybody involved in real estate. And I contend it's important for anybody who cares about those who live in rental properties.
Right.
Because of all the reasons that I gave before, because, landlords can only go so far. I think here I might also just take the opportunity to address for those that are not Lifestyles Unlimited members. We have over 50,000 members across the United States, and we teach a model that is very different from what people perceive landlords to be. A goal of our founder, Del Walmsley, was to combat the slumlords, to combat the people who are doing some of the things that you're hearing now in the news. That isn't what we teach. Our members are working with people who have been harmed, who have lost their jobs due to COVID, who are struggling to get back on their feet, who are struggling with the government to get support or unemployment money and have gone months and months and months without being able to get anywhere with the unemployment department and things like that. We're working with them. The people who are being evicted right now under the CDC eviction moratoriums are the people who are working, some of whom have received raises because they're getting kind of combat pay. Maybe they work in a grocery store and they're getting paid 10 cents more an hour than they were before. They're getting all the overtime they're willing to sign up for. And yet they're taking advantage of the situation and not paying their rent. And as hard as it is to believe, a lot of those folks are sending text messages to the people on site, basically saying, even though I'm working, I'm not going to pay you. And so the landlords are taking those into court because that's not what the CDC eviction moratorium is for. It's for people who are really suffering, not for people who have the money to pay and choose not to. But what you see in the headlines is landlords evicting in spite broad moratorium that says no evictions allowed. That isn't what the CDC has said. And so it's important for us as a group to step forward and not only talk to our elected officials, but also to be more vocal about how we as landlords manage and all of the people that we help. And if you go to Facebook or any of our social media platforms, and look at some of the things we've been posting throughout the pandemic, we've posted stories of what our owners are doing for their residents and how they're helping them. And I think that's important to remember too. This isn't about greed. This is a business that won't be able to survive under the types of changes that are being proposed. And if you're in this business, we're in it for life. And usually our children are as well, because they'll be inheriting our portfolios, and at Lifestyles, we're preparing our children to inherit our portfolios. So it's a huge impact on us individually, but that is going to cascade through the industry, as Lu Ann said. So for members, go to the Lifestyles Unlimited portal, thelifestylesportal.com, and take a look at the resources there. For those that are not members, you can go to lifestylesunlimited.com. You can see all sorts of resources there just on our public page. And you can also attend a free workshop to find out more about what we do. But we wanted everyone who was interested to have the information shared today.
And I just want to, as an individual who does own a number of rental properties myself, Lynn, with a story very, very similar to yours, who my wife and I worked at one point in time 7 part-time jobs to get through grad school, and had a child while we were in school. The government makes decisions, i.e., the moratorium on eviction, without stopping to consider that there are people out there who they didn't put a moratorium on mortgage payments. I guarantee you they're not going to put a moratorium on real property taxes. They just put a moratorium on you being able to enforce your private property rights. And that's something that, to me, is very, very strong, because they're forcing one group to pay the price for all groups. And our philosophy is very similar to yours. We work with our people. I think we can legitimately say, at least in our small properties, we really only have one person who has basically thumbed their nose at us, and said you can't do anything, and we've had to pay utility bills they didn't pay. We've had to do a whole bunch of things, but we've done it because we're in this game for the long haul. If you're in the real estate game, it is a long haul. You have to be prepared for that. But it can be painful at times. And this happens to be one of those times when it's a little painful. But if you have some questions, Lynn, I know maybe some people have sent you some questions. Maybe we can address those at this point in time. And if not, then we'll just urge you to get involved. Do what you can, do what you're comfortable doing, but do something.
Yeah, we have some great questions here. From Sandy, if no capital gains, how will passive gains be handled? Will we be able to write off passive negative carry against ordinary income? Will we still be able to carry forward our passive losses against passive gains?
And that's a question nobody can answer at this point in time. We just don't know. I wish I had an answer for you, because I've got some losses I'm carrying forward. But at this point in time, we don't know. It's up in the air.
Yeah, just haven't fleshed it out that far yet.
So,
will the Medicare surcharge still begin at $250,000 of income?
I anticipate that it will, but what you have to realize is that as soon as you sell a property, that amount goes on top of your other income. So you're always going to be, any year you sell a property, you're going to be in that generally. But there are going to be a few exceptions, but generally you're going to be in that 3.8% ballpark.
Yeah. And this is a good question, because it's something that we've spoken about just for as long as I can remember at Lifestyles. How likely is the elimination of the 1031 exchange, considering some members of Congress, like Pelosi, have $200 million worth of real estate, or more, some less, but many people in the House and Senate have real estate. It's part of a balanced portfolio and has been for decades and decades. And
Almost
so,
100 years, Lynn. It's 1921, next year, 100 years.
yeah. So I have some thoughts on that, but Dan, what do you think?
Well, that's a $64,000 or $64 million question, right?
Right.
You're right. Pelosi, through her husband, has made a very significant amount of money particularly in the Bay Area real estate where she's from. So, but what you need to understand is that there are oftentimes people in the know who can figure out or who can see a way around certain things. I can't tell you. Yes, you're right. There are a lot of people in Congress who've made a lot of money in real estate, and the question becomes, is that more important than their election? I don't know. I think we are probably at a higher risk of this changing right now than we have ever been before for a couple of reasons. Number one, I think the country is less stable at this point in time than it has ever been in my lifetime. Again, I'm 73 years old. So I think it's probably more, and I went through the Vietnam era and all of that type of stuff. And, people laugh at you and point at you because you got short hair. But that's number one. The country's in a bigger state of flux than I've ever seen it before. Number two, you've got huge pressure from the left, from Ocasio-Cortez, from people of her, and I'm just kind of using that as from very, very progressive people to make these changes. And that in the past, the D's have talked about it in their tax committees and that type of stuff and thrown it up against the wall to see what would happen. But I don't think we've had the public pressure, the public noise, the public outcry that you're going to see. Number three, this election, the D's offered to give away more than I have ever seen before in my life. And pardon my vernacular, but I call it buying constituency. So, you offer something to buy the Black constituency, you offer unlimited immigration to buy the Hispanic constituency, you offer forgive all college debt to buy the young constituency, and that the money for those things have to come from somewhere. And the history has shown us that it does not come from the constituency that it's being spent on. They have to get it from someone else. That's the me's and these of the world. That's the producers, because the government doesn't create income. The government just takes income and redistributes it, and in the process takes a big chunk out of the middle. So I think it's more likely this time maybe than it has been historically, basically for those three reasons. There's been some big commitments made. There's some real pressure from the left, and I think this particular individual is probably he has a much larger sail in the wind than any president I've seen elected before. In other words, this election was more about other people and what they want to do than it ever was about the Democratic candidate and what he wanted to do.
What do you think, Lynn?
I agree with that analysis. I think that we are more at risk of this occurring now than we've ever been before. And I think it's something that's easy to trade off the table. And I think as time has gone on, we actually have less and less business people in general, but real estate investors specifically in the House and Senate. And I think it's dwindling. We have people who have been raised for political office and have not done anything significant in the business community before being elected. And so there's a lack of perspective. I think we saw that. And again, regardless of your politics, right? I mean, hopefully there's things that we can all agree we observe. So we observed Bernie, and Bernie made a lot of money on his book. and he had some commentary on business and on minimum wage, and then suddenly understood why minimum wage doesn't work, because he couldn't financially make it work if he paid all of his help minimum wage. And that was a dose of reality, you know, and sure, it hit the right wing commentary with all sorts of commentary around it. But what it really was a wake-up call. And if you're questioning whether what I'm saying is true and that we've seen this before, look up what happened when the luxury tax affected shipbuilding.
Mm-hmm.
That's a
Good
great
point.
example. It's a great example, because it was, oh, all these rich people buying boats. We're going to tax the heck out of boats, and we'll make all this money. And like you said, Dan, I can't even remember what it was supposed to be redirected to. They nearly destroyed the leisure boat business, because it
Lynn,
stopped overnight, because no one needs a boat.
right.
And
No, I lived in Portland, Oregon at that time, Lynn, and represented lumber people and construction people and some boat people. And there were a couple of firms in the Portland area and a number of firms in the Seattle area that went under, just because of that. So they had good businesses, good business models. They were working, their customers were happy, their employees were happy, and then boom, they decided that they were going to tax it differently. And so, you know, another great example is the timber industry. I went to high school in Eugene, Oregon. Timber was huge, and I mean, I literally had friends who went to bed millionaires and woke up almost broke because the government come in and said, "Oh, we have the spotted owl. You can't cut any more timber." And it had been in their family for years. If grandma needed an operation, they'd go cut 3 or 4 loads, and you know, it was kind of a savings account. So these government decisions have huge consequences that are never anticipated or considered down the line. And I'm sorry for getting personal, but I mean, I just watched it happen to people. I watched them just go upside down.
And so the thing is, anytime you try and tax the wealthy, you have the problem that the wealthy can just simply decide not to do the thing you're taxing. If they're suddenly going to tax Carnival cruises because only the wealthy take cruises, and they increase the tax by, and actually probably a relatively small amount, will cause people to just simply stop cruising, and they'll go camping instead, or they'll take an airplane instead, you know. And so chasing the rich and trying to part them from their money is a difficult thing to do for government, because people made that money by responding to incentives, and businesses are formed and based on certain incentives that are provided to them, that if the incentives are different, they'll make different choices. And so that's what always happens. So there's lots of examples out there. Pelosi, I have no idea if the, you know, there's an argument in my mind that ultimately, like I think Lu Ann mentioned, or maybe it was you, Dan, mentioned that, you know, you say 1031 exchange to someone, and you know, 99% of the people don't have any idea what you're talking about. So it would be very easy for them to let it drop, right? They could just not say the words again, and I don't think they're going to get big pushback, maybe even from the squad, because I'm not even sure the squad really understands it.
I don't think so.
Right. And so we might, you know, it might just squeak through that way, and there's some self-interest involved in all of that. I don't think that that's a good way to approach our elected officials. I think if they say they're going to do something, we need to take them at their word, and then we need to give them input. And I think our input needs to be, for those of us who are real estate investors and have used or anticipate using this strategy, we need to tell them our story. We need to make them understand that we're not Donald Trump, right? We're not billionaires. We're not even, you know, we don't even have 10, 20, 50, 60, 70 million, right? We are average Americans trying to make our way in this world, and we chose real estate as our vehicle because of the advantages that the government put out there, and they were out there to incentivize people to create rental housing. That's a lot of these things. They are incentives to create rental housing, and most rental housing is workforce housing. It's an important part of our economy, and we just need to tell the story. So that's my thought on that. Somebody,
Real quick, the other thing is none of this can be passed without congressional approval. Tax
Right.
code changes. I thought for a while it could be an executive order, but it can't.
It
So
can't, no, you're right.
keeping the checks and balances to you people in Georgia are just, I cannot stress how important this is.
yeah. Let's see. So how much of the Biden tax plan can a Republican Senate majority prevent from being implemented? And I think you pretty much answered that question. You also have the issue that Americans have sent a strong signal by changing the nature of the makeup of the House. So they will probably not reach a 2/3 majority in the House, and so that will affect things as well. So I think that a Republican Senate can prevent a lot of this from even coming to, to the floor, because it's not even gonna go anywhere.
Yeah, and Lynn, let me point something out. If this was that important, if this was that earth-shaking, in the first 2 years of the Obama-Biden administration, they had all three branches, and then they lost the House, and they didn't push this through. They talked about it, but they didn't push it through. So he talks about all these things he's going to do. His first 2 years in office as vice president, he had all three branches, and didn't do anything with it. So here we are.
Right.
Essentially didn't do anything with it. Even with the healthcare, but I don't want to get off on a tangent. But the issue being that
Yes, you do.
I want to get off on a tangent, but you all on this call don't want to listen to me do it.
Right.
I keep a soapbox here close to my desk, but under any circumstances, for those folks in Georgia, it's really, really important, because so much of where the nation's going to go is in your hands. Pretty unusual for a state to have two senators being elected in the same cycle. I assure you that it was not by design. It's really odd. In fact, it struck me. I said that can't be, but it turns out it is. So I can't urge you enough to let your voices be heard. Whatever it might be, let it be heard.
Yeah. And and there's a lot to all of this, but I think the overall consensus is we need to pay attention this time, and not just assume that nothing is going to happen, because you do have a big push. And this is my personal opinion. I believe that it's possible that the Democrats, I don't know how to phrase the difference. So maybe I'm gonna call it the old guard, right? The old guard. It definitely, Biden comes from the old guard, and he was caught off. If you remember, when he first took the platform as a presidential candidate, he was still in the mindset that he grew up with, which is we all fight and we all make these threats, and then on Saturday we get together for a family picnic across the aisle because we actually like each other as people. And he got caught off guard by the extremists of his party, who it was, if you don't believe like we do, you should be dead. And he had to make some adjustments, and you could see it play out on the national stage. And so those influences are still there, and the voices are very strong. It's been very difficult for Pelosi to navigate these waters, and she is a skilled strategist. as political strategists go, she's, you know, she's up there. And she's really had to navigate these waters of keeping her party in line. So we have more pressure on the Democratic Party than we've ever had before, I think, for some of the more what people are calling the radical agenda. So that's why I think that we need to have our voice be heard. Somebody expressed that, you know, it doesn't really matter if you vote because who's counting the vote matters. I think we have to work on both ends of that, but I think to not vote doesn't make logical sense to me. So
Inexcusable.
and so do you think so we have a couple questions here for those of you that are asking about the fundamentals of 1031 exchanges. We do have a class that we provide when someone joins and takes our financial freedom program seminar, the weekend seminar. If you answer our questionnaire, we actually give you the class that Lu Ann has done that talks all about the 1031 exchange. And you certainly can reach out to them as well. Their numbers are here on the screen to ask those questions, because it would be another hour at least for us to go through how 1031 exchanges work. So but some people are asking, is it too late to do a 1031 exchange? Should they even start one now? And I actually feel
Yes,
different. I feel like if you ever wanted to do one, get it
exactly.
together and get it going.
Yeah.
We have never been so busy. And I don't know if it's that people are in that mindset or just that the real estate market's so hot, but absolutely go ahead and get it done, start it.
And let me just point out that tax law is written so that it becomes effective at some future date. It cannot be ex post facto. They cannot backdate it. So I believe that if you're in the middle of a 1031 and they change the rules, you know, just everything about the IRS says you have an opportunity to complete it. You know, if you're thinking about it, by all means, if you're going to execute it, I would say sooner, not later, is to your benefit.
Mm-hmm. And we're getting questions about, yes, this has been recorded and it is going to be made available. It'll be out in all of our social media pages. So Facebook, MeWe, Rumble, YouTube, all of those places you will find it under Lifestyles Unlimited. And usually anyone who has attended, you will get an email from us that also tells you where you can source the link. Feel free to share it with anybody. Direct people to our the easiest thing would be our Facebook page. Pick it up from there. We want as many people to see it as possible. What does your crystal ball reveal about real estate prices next year and beyond during the Biden administration? Part of it depends on what happens here. Dan mentioned that you will see if 1031 exchange goes away. We haven't talked too much about the step up in basis. When I die, my kids will get a step up in basis on that property to take it to the value it was the day that I died, basically. And then it exempts them from the taxes on the gains that I created in that property. Those two strategies go away, you will see it does make properties less valuable. There's less strategies for us to use to create an income from them, and that makes them less valuable. So what's playing against that? Supply and demand. So you will see the answer to what happens to real estate prices, in my opinion, is it's going to vary drastically from state to state. We're seeing a drastic reduction in the price of properties in San Francisco and New York. We're seeing in those cities also even more reductions in properties, townhomes and condos, for instance, that are in tall buildings that need elevators for access. We're seeing prices driven up much higher in Texas, Colorado. Here in Nevada, it's insane. It's absolutely insane. We have over 10% of our population here in Nevada unemployed, and yet our real estate prices have gone through the roof. They're higher than they've ever been. They're higher than they were in the bubble years before the Great Recession. And that is from people moving from New York and California. Can't tell you the number of California plates we see here in Nevada, before they register their cars and change them over. And they're paying top dollar and competing for properties, and they're seeing that in Texas as well. So that's going to keep property values high.
Lynn, I think there's two other things to take into account here. Number one is the interest rate. If that's a huge factor right now. But number two, that I really want to talk to people about is property types, because your residential property, everybody still has to have a place to live. One thing that we're seeing through this pandemic is everybody doesn't have to have a place to work. Okay? You can work from home. I did. I did for about 5 weeks. It's very simple. And technology has allowed so many of us to make that change. I was talking to a friend of mine who's an attorney in a major law firm, and he says, we're talking about going from 4 floors in a major downtown Denver building to 1, and simply having a dozen small conference rooms that you can meet with your clients in, because he said, I don't have to write my briefs here. I can do that from home. And I would prefer to do that. I don't have to drive 40 minutes into the office every day. He said, I'm much more productive. His comment was, I commute down the hall in my bunny slippers. But I think we're seeing that being a lot more attractive. And so I think you're going to see an awful lot of retail office space. I think you're going to see a significant amount of retail store space available. I think you're going to see repurposing of some big boxes. I think you're going to see some major shifts in the commercial real estate arena based on the use of the properties. Just a word to the wise.
Yeah, we're already seeing some interesting repurposing plans. People are on the vanguard of that, repurposing malls into senior living communities and all sorts of stuff going on. And that's the thing that I want to encourage people on, because some of the questions here is, okay, so do we give up? Do we just sell all our property, buy a luxury home, and try and just preserve our cash? And I'm not giving up on that yet. I think this has to play out. I've spent a lot of time with alternate strategies, because it's a pivot point. Just like, Lifestyles is a great little microcosm. Here comes a worldwide pandemic for a company that we're all face to face, right? I mean, that's the primary. For 30 years, Lifestyles has been a face-to-face organization. Come down, meet us. We're real. To Dan's point, we have offices, and big ones, right, where 500 people can have a good time in one room. And we pivoted within 2 weeks to 100% online during the shutdown. That is really what I would encourage you to do. Keep your head up, keep your eyes open, don't let fear set in, and we will find a way, because for entrepreneurs, there's always a way. I truly believe that. America needs housing. The government, some of our representatives, we keep beating up on AOC, but it's because she's really done a great job of branding her name. But she's one of the people who signed off on the original version of what is the Rescue Act called?
The Green Deal? The Green?
No, the Rescue Act itself.
Oh.
it's gone right out of my head, but there was an original version written in the House that didn't even make it to the floor because half of it was actually so unconstitutional that they couldn't see their way past it in the House. And so it never did get forwarded to the Senate. A much milder version did. But in that version, it was basically a takeover of private housing. It was, there'll be no evictions for a year. And if you need help as an owner, if you take a single dime, then if you're going to sell your property, you have to offer it to the government first, and the government will see if they can find a nonprofit who wants to run it. That is literally the road to hell for those residents. Literally, we've done this too. We've done this too. If you look into the history of some of the projects from back in the day, they became literally terrifying places to live and inspired some movies where whole states became prison states, right? I mean, it was really, really bad. And but I think that we've done a much better job. And this leads into another question here: is the National Association of Realtors and the apartment associations doing anything? Yes.
Yes, that
Yes.
I was.
Yes.
Folks are hard at work.
And
That is,
there are lots of lobbying that's going to go on, and that it's already going on in Washington.
and their focus is on education. Their focus is on what really happens. You know, this is a great soundbite for you to run an election on, but if you actually do it, you won't get reelected, because here's what happens. And it's explaining how the industry works. And then it isn't just complaining about a problem. Somebody else put it, probably the best question of the night is, so what's the solution? So thank you for asking that question, right? Because entrepreneurs also don't just sit and complain about something without having some ideas of how to solve it. And that is what the apartment associations in particular are coming forward with. And Lifestyles Unlimited has aligned with the apartment associations. Every couple months, I meet with their lobbying teams and their legal teams, and we discuss what's going on. We discuss resources that we have. If they're going to put a legal argument forward, we go out to our members to try and find people who are interested in being represented, right, and being the part of that lawsuit. And it's all about putting the argument forward and putting forward another idea. So yes, that is going on. And then, you know, again, we ask our members to write and to express that to their individual lawmakers. Hey, there's a better way. Yes, people are really injured. And no, someone who is down and out shouldn't be thrown out in the street. We all agree that that's a terrible, terrible solution on a good day. And during a pandemic, it's an awful solution. But here's another way to achieve it. And that has actually helped. And so I have confidence that we will get through this time. I have confidence that we can navigate it all. People need a place to live, and real estate still is a great investment. And so I just remain optimistic.
If I can just add one word to that, Lynn, is your elected representatives need to hear from you, because they spend the vast majority of their time in a bubble. Inside the Beltway is a bubble, and it's got this big green roof over it that is made of cash. And they're either collecting it or giving it out. And you need to remind them that, hey, we're back here producing that cash. And we need you to understand that you're either making it more difficult, or you're making it impossible, or you're making it less. Whatever it is, you need to educate them. They, you know, with all due respect, and I've lobbied in DC, so I understand it. At least I've been exposed to it. I don't know that I'll ever understand it, other than it's just you know, they want to shake your hand with one hand while the other hand is reaching in your pocket. But the issue is that you've got to tell them they're not going to voluntarily call you and ask you your opinion. You've got to tell them. And none of us got where we are by being less than energetic, by being less than intelligent, and by moving forward with what we thought was best for us. And that's not going to change, no matter what. If I have any confidence in Americans, it's that you can throw them into a situation and they'll come up with the best answer for their particular situation. So tell your local representative, tell your representative, tell your senators how you feel about things, because trust me, their only concern is getting reelected, because if you don't get reelected, you get kicked off the bandwagon. And if you're not on the bandwagon, you don't get the cash. So particularly you're at the House of Representatives, that's where the tax writing starts. Those are the guys that are up, gals that are up for election every 2 years. So they got to face you, basically every 2 years. Tell them how you feel. Give them good, solid facts. Emotions don't cut it. Give them good, solid facts.
That's a good point, and it's important too to not hit with don't hit with the political sound bites. They're, at this point, I think everybody is just deaf to political sound bites. So facts. And where does this lead, and why do we need to solve it a different way, and how can we solve it a different way, and lay it out for them, and be respectful. I think and be respectful even if you're angry. I think that's really important. It's the HEROES Act that I was talking about, and if you want,
there you go.
If you want to see what the squad has in mind for you, go read the original HEROES Act. It's still out there. And then it became HR 6566 once it was given a number, but it was changed by that time. Thank you very much for the members who came forward with that. I just couldn't come up with it. We just got a couple more questions and then we'll wrap up. Does the clawback provision go away if I do a 1031 out of Oregon into Arizona? So it's state to state.
Yeah, no. Oregon, unfortunately, I used to practice in Oregon, lived there for a number of years. They followed the foolish idea of California and did the clawback. So it does not go away. I can tell you, as a practical matter, the state of California is spending more to support the franchise tax board than the franchise tax board is bringing in. So as one of my clients who moved with Toyota to Texas said, I'm showing my attitude finger to the state of California. I'll report it 1 year and then they can figure out what to do with it thereafter. And I apologize for that, but that was a quote. So no, it does not. Theoretically, it does not go away. The clawback is still pretty new and we haven't seen the long-term effect. My concern is what happens if you sell in California, buy in Oregon, you got a clawback. Then you move to Michigan, then you move, it's too early to tell what the real effect of those clawbacks are, except that they're not producing what they were expected to produce. And if those of you who don't know what a clawback is, let me just take one moment, if I may. Listen.
That was exactly what I was going to say.
The clawback is a state provision enacted by about 4 or 5. California and Oregon are the two that popped to mind immediately. And what it says is we will allow you to defer your gain on this transaction, but every year you have to report to us that you still own the property. And if you ever, after your 3rd or 4th property, if you ever cash out, then theoretically you owe us the tax that you didn't pay 15 years before that. Okay? So they're going to claw back the taxes they did not collect when you left California and moved to Nevada, and then when you moved your money from Nevada to Texas, and then from Texas to Florida or wherever you went.
Dan, it's California, Oregon, Montana, and Massachusetts.
There you go.
Google works wonders.
Right.
And I think it's only those 4 states because the other people have watched what's taken place in California. California's had it the longest. And as we used to say in Oregon where I practice law, most bad ideas start in the state of California. And this is certainly one of them.
I'm from California, spent the majority of my life there, and I would agree with that. Unfortunately, I watched, again, 58 years old, so I watched the heyday of California, kind of the tail end of that. I watched the conservative California that built the state, and then I watched it declined, and in 2001 decided it was time to leave the state because they'd become so unfriendly to business. And that's why Texas is the way it is, folks. Lifestyles Unlimited was started in Texas, but our founder, Del Walmsley, is not from Texas. He started traveling, and he stopped when he found a place that he thought he could, could do business in. And that was Texas at the time. And Texas has worked diligently. This didn't happen by accident. They still, the representatives of Texas travel all over the world incentivizing businesses to come to Texas, because after, I think it was the 80s, the oil crashes of the 80s and the devastation of that took a decade to recover from, and they didn't ever want to go through that again. And that preparation created a tremendous success in what we call the Great Recession recently, right? Is really, there was a lot of opportunity and very little suffering in the state of Texas during that time. I was there and very impressed with the results of decades of work.
Yeah, the best example I can give anyone who wants to take a look at it, at a good case study, is look at Toyota of America, who left Rancho Cucamonga, California, and moved to Plano, Texas. And in excess of 10,000 employees went with them. And we did a lot of stuff in that process. And as one of the VPs told me, he said, Dan, it was a tax move, pure and simple, end quote. Now that's the same guy who told me what his attitude towards the state of California. But if you want to see what happens, just look at, they finally drove Toyota out of California with their tax schemes.
Mm-hmm. Yeah.
And
I
10,000 well-paying jobs went with them.
And yeah. I just bought a Toyota.
Oh.
And one last question, and then there's Frank has got a good comment here that I want to chime in at the end. Does the clawback end when I die?
I
don't know, Dan. What do you think?
I don't think so, but I don't have an answer for that. It hasn't been in effect long enough for anybody to. Right. I don't know that.
We'll do some research on that. Send us an email, whoever that is, and we'll see what we can figure that out. That's fun.
I'm knowing California and having been involved in the legislative process, I'm going to say it probably does not.
Yeah, I would agree. That if I was going to guess, I'd put all my money on no, it doesn't end.
I'll bet you lunch it doesn't.
So, and then somebody, when you mentioned that you Googled it, somebody said, go to DuckDuckGo. So for those of you who are concerned about some of the things that are going on and you don't want to be traced or you don't want to be advertised to, what happens is Facebook, Google, YouTube and Twitter, they track what you click on, what you do, what you look at, and then they serve up ads. And that's why you can be, looking at a new Toyota, and then all of a sudden, all you see on Facebook is ads for Toyotas, and that's why that happens. DuckDuckGo, kind of like the game we used to play when we were kids. Duck, like quacking duck, 2 times, and then Go is a search engine that doesn't do that type of tracking.
Oh, cool! Thank you,
Lynn. I'm a DuckDuckGo user and have been for some time, and I can't recommend it highly enough. Mm-hmm. It cut the junk on my screen probably by 40 or 50%.
Oh yeah, I love it.
Yeah, and I have never heard of it. That's awesome.
Yeah, DuckDuckGo. It's on my. I mean, it's my search engine.
Yeah, it's my go-to search engine as well. And then the Facebook alternative is so if you, and again, I would think this would be people on either side. I'm somebody who I want to hear from the other side. I want to hear everybody's point of view, and I'm perfectly capable of saying, hey, you're nuts, right? I'm able to do that. And I don't need Facebook to protect me from you. I could do that myself. So the Facebook alternative is called WeMe. We
No,
and
MeWe, isn't it?
MeWe. Sorry, MeWe. So it's me and we, MEWE. And you can find lifestyles there. You can find me there. You can find Lu Ann there. Don't know if Dan's out there or not, but I know Lu Ann, you're out there.
I
Um,
am.
and then the YouTube alternative is called Rumble. That's been around a while. And then the Twitter alternative has just gone out of my head. Somebody help me.
Parlor.
Parler. Yeah, which is the first alternate social media thing that I went to.
Oh, parlay. It's PARLER.
PARLER. And I
Yeah.
believe that was actually founded out of Nevada, out of the Las Vegas area. And again, it's been around for several years, but they were down on their knees trying to hold the weight of all the new people coming over. There was one day during the election where I think they had 1 million new users coming from Facebook in one day. So so if you're interested and you want to have a conversation, and a lot of people are saying these are just right-wing sites, they're not. They're sites where people can converse and decide on the content of other people's thoughts themselves without having fact checkers in the middle. And it's
advertisers.
and advertisers. Again, yeah, you're not being stalked by advertisers, so it's kind of nice. All right, so I think we're done for the evening. There's a whole lot of thank yous. Dan and Lu Ann, thank you again for this terrific breakdown of the Biden tax plan. We really appreciate all the effort you put into the presentation and for bringing it to all of us. And once again, you can find this presentation out in the next couple of days. It'll be out on social media, and you'll be able to pick it up and send it to anybody that you want. So the most important thing is stay happy, stay healthy, hug your family, let them know you love them, and stay encouraged and positive. I think that we are heading into probably a decade of change, but change can be good and change provides opportunity. And that's what I think that we ultimately will see ahead.
And thank you, John, for doing the slides.
Lynn and John, thank you so much.
Thank you so much.
Couldn't do it without you. Wouldn't want to do it without
Absolutely welcome. You're welcome,
Have a
guys.
great night, everybody.
you. Have a great evening, y'all.